firstly, I'm going to start with the Everything Code. The Everything Code is the proprietary thesis that we built at Global Macro Investor that we actually now run our portfolio for XPAM, investing in the very best hedge funds. We use this Everything Code as the basis. And it's the one where I discover that the debasement of currency is kind of everything and how it's very cyclical and it's understandable and forecastable as far as we can tell. Obviously, things can change. Nothing is a pure, perfection. But I think this is right, and it seems to be proving itself out right. So firstly, we observe that over time, the trend rate of GDP growth has been falling in the United States and all around the world. Current trend rate of GDP growth is about 1.75%. Why is it falling? If you remember, trend rate of GDP is driven by three key factors. One, population growth. Two, productivity growth. Three, debt growth. So let's address these three factors. Firstly, let's have a look at productivity. Productivity has been declining over time as the workforce has been aging, and that lowers the trend rate of GDP. Debt, on the other hand, has been rising. But what we find is that household debt growth actually stops in 2008 because the banks just stopped lending to people. So it's just harder to accumulate debt. Also, corporates have also been paying off debt and have really not been growing as fast as GDP. But really, a lot of the debt growth is now driven by the central banks, as we all know. Currently, the US is running massive deficits and is financing it by issuing yet more debt. And we'll come on to that in a minute. But the key thing here, the thing that drives everything for the Everything Code and the world around us, the return on assets, the inflation, everything is driven by demographics. So here's the working age population, aged 15 to 64, trend rate of growth. It's been declining over time as the population ages. Those people are less productive. The older you get, the less productive you are. They had borrowed debts in their early years and now are debt tapped out. So this explains a lot, and I've talked a lot about this on Real Vision in the past. But we can also project forwards. And if you remember my piece about the retirement crisis, I've been introducing this chart for a while, which is the labor force participation rate versus the deaths rate. This is the births rate going forwards by 14 years. And obviously the birth rate drives how many people in the labor force over time. And it suggests that participation in the labor force should continue to fall over time. Now, we've had some pickup as part-time workers have come back into the workforce because people don't have enough money. And we'll see some of that too. But over time, we're going to see the labor force participation rate falling because the replacement of new people in the population is not as much as people leaving the workforce. And that is the problem that slows economies. It's affected Japan, now affecting China, South Korea, Taiwan, and most of Europe. So anyway, that is the megatrend. But this megatrend has some special qualities. When you strip everything out, and I keep saying demographics is everything, you find that the labor force participation rate is exactly mirrored by US government debt as a percentage of GDP. So what it says is as the less people in the labor force, the economy slows, but there's all of the services to pay for the old people, the government debt increases. That correlation is stunning, and that is an incredibly powerful chart to understand the world we live in today, why governments keep issuing debt, and eventually why they're having to print money to solve it. It's all a function of population. So what they do with that debt is they add liquidity into the system. That's the debasement of currency that I've talked about. And you can see the correlation between Fed net liquidity and the US government debt as a percentage of GDP. They're basically the same thing. Yes, the scaling's different, but overall, the trend is the same. So they're using liquidity to pay for the growth in debt. by debasing the currency. It's called financial repression. The other stark thing that we found in the Everything Code is actually the real mechanism is that most of the government debt increase is just paying interest on existing debts. They're not actually borrowing a lot more to invest in the economy. It's basically servicing of old debts. And so there is a very strong correlation between the interest payments from the previous cycle and then the liquidity for this cycle. So i.e. they issue new debt, it comes up for renewal, they've already been issuing new debt again this cycle, so to pay for the interest payments from the last cycle, they debase the currency via the Fed liquidity, so they're increasing liquidity into the system. Now look at that curve, that's the expected path here, driven by the interest payments from the pandemic debt, which was a huge increase in debt. Now, this debt keeps compounding, obviously, because you're adding debts on top of debts on top of debts on top of interest payments. So I don't expect it to play out fully like this, but we should expect a big increase in liquidity going forwards, and that's crucial to the theory. You see, look at that trend of total liquidity. Think of it, again, in a different world. That is the ongoing trend of debasement of currencies. That, when you debase the currency, gives you an optical illusion that asset prices are rising. So this chart of the NASDAQ versus the total liquidity index shows how correlated they are. It's actually 97.5% correlation. Now, the NASDAQ actually outperforms this because it's a secular trend. But this debasement explains almost all of the movements of all assets over time, which is why everything is so correlated. Yes, some things lead, some things lag, but this is the crucial chart to understand. The answer to the demographics is more debt. The demographics is causing a slower economy. And to get over that, they issue more liquidity, debase the currency to pay for it. That makes asset prices rise. This is the Everything Code, and it's really important. You see, most people don't understand that this is the global liquidity index from all the major central banks. It's growing at an 8% annualized rate. Now, once you add in global inflation, and let's call global inflation about 4%, you've got a 12% hurdle rate for any investment. Now, that's pretty staggering, because if you think about the S&P 500, it does about 12% a year. So basically, you're not getting ahead by doing it. Your savings aren't accruing future value, just present value. This 12% hurdle rate is a huge problem for people if you don't understand it. You are basically getting poorer if you don't hit your 12%. So if you're just investing in bonds and think it's a good idea to get the 5% interest, well, your future self is getting poorer. So when we look at global equities versus the total liquidity index, we've seen that since 2008, from the crisis when they started printing money, it collapsed, but then it's been sideways ever since. So they've basically offset the balance sheet but done no better. And if we took it from 2007, before the big printing started, it's actually lost 2.54% a year versus the debasement. So you've been poorer for owning equities, generalized global equities, than the debasement itself. So that's cost you money. When we talk about crypto, I use the charts of Bitcoin here because Bitcoin has the longest price history. It too is stunningly correlated with global liquidity. You see, Bitcoin has an 87.5% correlation, not as high as the NASDAQ, because, as you can see, it's the periods of outperformance that lowers that correlation. When we start to get, full kind of mania, crypto mania cycles that you get in this exponential asset, because it is a much more exponential curve, because it's driven by tech adoption. And we'll come on to that in a second as well. But you can see that liquidity is the driver of Bitcoin plus technology. But when I look at Bitcoin versus global liquidity, It's outperforming the debasement by 105% a year. I mean, that's a staggering difference versus global equities, which are not doing anything at all and are probably negative. That's a huge, huge difference in your future purchasing power, which is why this is such an important asset. And again, I'll come on to more of this in a bit. But we've ascertained that technology stocks are in a secular bull market. They're 97.5% correlated, but they've been rising very well over time. However, when you look at NASDAQ versus Bitcoin, this is a crucial chart. So NASDAQ is the best performing equity market in the world, essentially. But when you look at it versus Bitcoin, since this period of debasement, NASDAQ has underperformed by 99.93%. Just wrap your head around that. And it doesn't stop. It's underperforming by 45% a year. And as you can see, we're going to break to new lows, and this chart will just continue as Bitcoin and crypto eat the world. It's something I call the supermassive black hole. I look at Bitcoin charts versus every asset, and they're all the same. They're all down 99.9 something percent. And then I look at relative values between Bitcoin and Ethereum, or Bitcoin and Solana. And that's where you get to choose what you think the fastest horse is. And that's why I chose Solana this cycle. But basically, crypto is the supermassive black hole, the asset that appreciates faster than anything else, and on a risk-adjusted basis too. So what's driving this? Well, what's driving this is obviously the debasement of currency, but why the other 105% excess returns versus that? Well, it's this chart. This is starting the internet at 5 million IP users and crypto at 5 million wallets, active wallets. So yes, I know that neither of them are perfect measures, but I'm not looking for perfection. I'm looking for understanding. And what we saw is the internet, which was the fastest adoption of technology the world had ever seen, it grew at 76% a year and then slowed down after year 8 to 43% a year. Crypto has been growing at 137% a year. It's now at 516 million users versus 187 million of the internet at the same stage. And then what we did is assume that crypto just slows down its growth to the same as the internet. I don't think that's going to happen. I think it'll be faster. But it gets by 2025, the end of 2025, we get to 1.1 billion users. So that'll be double the pace that the internet grew. And because this is a network and the tokens are at your participation in the network, they go up a lot. It's as simple as that. It's Metcalfe's law. So when you've got the biggest technological trend of any asset class in all of history, you're going to make a lot of money if that trend continues. This is why it's the biggest macro trend of all time. But it goes on. If we look out further using the internet adoption growth, and we slow down the trend rate of growth of crypto to the same as the internet going forwards, we get to 4 billion users by 2030. That's half the world's population. Now, will this be perfect? It's been pretty perfect so far. I've been showing this chart for 5 years now, but let's assume not. Either way, these numbers are simply staggering. And that's why you get that log chart of Bitcoin over time, because it's the adoption curve is what you're seeing, which is why the sell-offs, even though they sound terrifying, down 75%, are just blips in the overall trend. And over time, it just keeps compounding growth. You see, to show how starkly this compounds growth, this chart of all of the asset markets since 2011, I think is hilarious. So you've got the usual NASDAQ, blah, blah, blah. So we can look, ignore the top three for a second. NASDAQ, 17%, beating the debasement, that 12% number, and compounded 800% since 2011. That's a fucking good investment. What a great investment the NASDAQ's been. Then we go up. Look at the top, Bitcoin. Bitcoin, every 3 years, is the worst performing asset. The next 3 years in a row, it's the best performing asset in the world. And even with the drawdowns, those scary drawdowns that everybody hates, it's compounded 20 million% returns. Since we started talking about Bitcoin on Real Vision in 2014, it's up 450,000%. Its annualized return is 139%. That's mind-blowing, right? We've never, ever in history been given an asset like this. But when you go out the risk curve a bit to newer crypto, getting up the risk curve, getting up the adoption curve, well, in 2016, out comes Ethereum. Out of the gate, monster returns, huge drawdowns, compounding returns, 364,000%, annualized at 149%, which is better than Bitcoin. Solana came last cycle, again, came out of the gate, fell 94%. What are the compounded returns? 7,713%, which is 200% a year. Right, so there is no asset class in all of history that's ever performed like this, even with the drawdowns. This is why I keep saying to people, you just want to buy and hold them. And if you can make the right switch amongst the big ones as the next big network gets adoption, you'll make even more compound returns. Right, this is the biggest gift we've ever been given as investors. And it's the biggest macro trade of all time. Let's go back to the risk reward topic. Here's Jurrien Timmer's chart that I've stolen from him, which is on the left is all of the bubbles of risk rewards of assets and how they look. Pretty typical. And this is how asset allocators think about it. But when you add in Bitcoin, you end up with a massive blank page with at the very top right, this fucking alien risk reward, which is Bitcoin. Crypto is a complete alien in terms of performance and risk reward. This chart includes the drawdown of 2022. So you see, again, I keep saying it's a gift, and people still don't really understand what a gift it is. It's something unlike anything we've ever had in history, and it gives us a hell of a chance to make money. So to sum